What is going on, investors? I hope you're all having a good day, and if you are an Amazon shareholder, then I'm sure that you're certainly having a better day than you were having yesterday. And the reason for that is because yesterday the stock fell by almost 8% for seemingly no reason whatsoever, other than the fact that Facebook fell off an absolute cliff, and we saw that they fell by 25%. But these two businesses are absolutely, completely unrelated. So that just goes to show you how irrational markets can be. However, today is a new day, and Amazon just posted their Q4 2021 earnings, and the stock surged by 14%, absolutely taking back all of that drop and a little bit more. So you guys know the structure of these videos by now. This is not a channel based on hype and nonsense. This is a channel based on data and fundamentals, and therefore we're going to run through the income statements, we're going to look at the cash flow statements, and we're going to look at the balance sheets to determine whether this price rise is actually warranted or not based on the most recent result. And then we're going to flick across to my personal valuation model for the business, which comprises a discounted cash flow and earnings multiple model approach in order to try and determine whether the price today represents a good opportunity for a long-term outperformance of the market. But before we dive into the earnings report, we're going to take a quick look at the news headlines to try and understand why the stock surged by 14%, despite the fact that their revenue actually missed by $230 million. And straight away you can see that the reason for that is because Amazon posted earnings per share of $27.75, and that compares to analyst estimates of just $3.54. And yes, you really did hear that right. Amazon's earnings per share were almost $28 compared with analyst estimates of $3.54. So then why has the stock only increased by 14% despite the fact that their earnings have outperformed by a factor of about 8? But look, I'm not going to hold you ransom until the end of the video, making you watch the entire video before telling you what's going on here. So I'll just be straight up and I'll tell you up front. What we can see here is the fact that Amazon have an investment in Rivian, and we all saw that Rivian saw a huge increase in the value of their shares in Q4. And because Amazon hold a minority stake in Rivian of less than 20%, any gains in the value of that investment are reported as non-operating income. And so we can see $11.8 billion of the total $14.3 billion was actually just their gain on that Rivian investment. Now, Amazon haven't sold their stake in Rivian, and therefore this is an unrealized gain. It makes absolutely no difference to the business in reality. This is not a cash flow to the business. And actually, when you look here, you can see that from the 31st of December, which is the reporting period that we're referring to, the stock in Rivian has actually fallen by 40%. And so therefore they're going to report a loss, most likely in the following quarter, depending on what happens between now and the end of March. So the one thing that absolutely nobody should be doing is looking at that earnings per share of $28 and thinking that is the norm going forward, and therefore multiplying that by 4 to get you your sort of forward earnings, which would be $112. Looking at the share price of $3,000 and thinking that this is a company that's trading at a forward PE of something like 27. Now, if you ignore for a moment the Rivian investment, when you look at some of the headlines, you might actually start to get a bit concerned. And the reason for that is because operating cash flow decreased 30% to $46 billion for the trailing 12 months, compared with $66 billion for the year earlier. And free cash flow actually decreased to an outflow of $9.1 billion compared with $31 billion for the year before for the full 12 months. So if all you did as an investor was read those two sentences, you would be heading for the door, because you're seeing a business that's operating cash flows are reducing and they're now burning through cash rather than generating it. The fact of the matter is, though, and I've discussed this on a previous video so we won't go into too much detail on it, is that Amazon are investing in capital expenditures like pretty much no business has ever done before. So you can see here Amazon's capital expenditures in purple, and you can see from 2020 they have gone on a parabolic increase, investing in their business, laying the foundations so that later on they have the best infrastructure in the world and continue to dominate the e-commerce space for the long term. So when you compare Amazon's capital expenditures of $40 billion with the other big tech companies of between $15 and $20 billion, well, then you start to really see the scale of these investments. So diving straight into the income statement, we can see for the 3 months ended 31st December 2021, total net sales were $137 billion. Now remember, I said for the 3 months to 2021, this is a company putting in $137 billion of revenue. We look to the full year and they're looking at $470 billion. That's almost $500 billion in revenue for the full year. And by the time we get to next year, they will certainly pass that milestone. Now, with that being said, that revenue for the quarter did actually miss expectations by $230 million. But $230 million on revenues of $137 billion, well, I don't think we're going to get into too many arguments about that. As we move down the income statement, we can see that it cost them $83 billion in order to generate that $137 billion in revenue. And the great thing about this, right, is that if we look to the period before, the increase has only been around $3.5 billion to generate that additional $12 billion in revenue. So their gross margins have actually increased from around 36% to 39%. Now that's quite a significant increase, particularly given the times that we're in. However, with that being said, we can see that their total operating expenses have actually increased by about $15 billion. Now, if you remember that I said that their revenue had increased by $12 billion, well then it doesn't take a genius to work out that their operating income therefore has fallen, and it's fallen by about $3.4 billion. Now, when it comes to actually understanding what is the driver of those increased operating expenses, well, we can see here that fulfillment costs have actually increased by around 25%. And the reason for that is because labor costs have increased so much. Now, you have to remember that Amazon employ 1.3 million people, and therefore if you get significant increases in labor costs, well, that is going to hurt Amazon. We come further down and they're spending more money on technology and content as well, and a lot of that is going to be related not only to Amazon Prime, but also developing new product. Now, this technology and content spend is akin to research and development, and therefore an uptick in that isn't necessarily a bad thing, so long as that we're going to see a return on that investment in the long term. Amazon are also pumping a hell of a lot more money into marketing, which has increased by around $3.4 billion in the quarter. So then you really have to ask yourself, are these operating costs going to continue to increase at a greater proportion than revenue growth? And if so, then you really should be concerned. The short answer to that, in my opinion, is no. Wage inflation is not going to continue at 10 and 15% per year. Not everybody is going to continue to receive wage increases of 10 to 15% per year for the rest of Amazon's life. It's just not going to happen. And as a result of that, I expect that these costs will actually stabilize whilst revenue continues to grow, and therefore as a percentage of revenue will decrease. So that brings us down to operating income of $3.5 billion. We get a little bit of interest income. We also have to pay a little bit of interest through expenses. And then we come down to the $11.8 billion gain on the Rivian investment, which you should pretty much just discount in my opinion. Now, it's worth pointing out that Amazon Web Services, which is the fast growing segment of Amazon's business, and by the way has the highest profit margins, has actually grown by a significant amount. And we're looking at something like 40% revenue growth in the quarter. And the reason I mention that profitability is because we can see here that the operating income from that segment was $5.3 billion. Now remember here, right, we've got $18 billion of net sales through Amazon Web Services, and that generated operating income of $5.3 billion. You'll remember that just a moment ago we saw operating income of just $3.5 billion for the entire business on net sales of $137 billion. And therefore it doesn't take much to work out that the other segments are actually loss-making at the moment, and Amazon Web Services is really what you want to be paying your attention to. Now, does that mean that Amazon's e-commerce business is actually no good because they're loss-making? Of course it doesn't. We know that it usually is profit-making, but due to the increased costs that we're experiencing at the moment, it is having a significant effect on the business. Over the long term, we'll see that business return to profitability once again. When we then come down to the cash flow statement for the business, well, this is where it starts to get quite interesting. So we've got net income here of $33 billion. We make some adjustments for non-cash items such as depreciation and amortization, stock-based compensation, as well as, remember, the Rivian gain on that investment. And as a result of that, we come down to net cash generated by operating activities of $46 billion. Now, from that $46 billion, they actually spent $61 billion on capital expenditures. Yes, they did sell some property and equipment as well, so they got $5.5 billion back, but they've got a net spend on capital expenditures of around $56 billion. And that is why you see for the trailing 12 months a free cash outflow of $9 billion. Now, when we come to my valuation, you'll see that I don't use non-GAAP free cash flow. I actually use unlevered free cash flow, which takes into consideration stock-based compensation. And the reason for that is because although it's not a cash outflow, it still is a significant expense to the business. And if you want those shares to remain constant over time, well then Amazon are going to have to repurchase the shares that they've effectively issued to management. And in doing so, they have to use that free cash flow. Now, when we come down to the balance sheet, we can see that this business is holding a significant amount of cash. So we can see here that they've got cash and cash equivalents of $36 billion. They've also got marketable securities of $60 billion, and therefore they've got around $96 billion in effectively cash. So when you're seeing that cash outflow of $9 billion, well, you shouldn't be concerned, right? Because they've got a significant amount of cash to support those investments that they're making. Now, it's not all just cash on the balance sheet, right? Because they do have some long-term lease liabilities, and I say some, right, with a pinch of salt, because they've got $67.6 billion of lease liabilities, and they've also got $49 billion of debt. So they've actually got more debt if you include those lease liabilities than they do cash on the balance sheet, but clearly there's not going to be an issue in terms of repaying that. So then that brings me on to my valuation model for the business. So we can see that they've got a market capitalization of $1.65 trillion, and they've just posted revenues of around $470 billion. So we're trading at around a 3.5 times revenue on a trailing 12 months basis. So we can see here that I've got previous results here, and then I've got my forecasted results to the right of that. In terms of where I pull this data from, well, I take it directly from TIKR Terminal, simply because it's the easiest and most efficient way of me doing my valuations. So this table that you're seeing here, which includes all of Amazon's financial details, which includes the income statement, the cash flow statement, and the balance sheet, is simply pulled from the TIKR Terminal website, and they make it so easy for us to do, right? We can just go here, copy table, I then paste that into my Excel, and it makes everything so much easier. Not only that, right, I actually have the Pro plan for TIKR Terminal, which means that if I pull it all the way back, I can go back as far as 15 years and really get into the details of what is driving this business. So because of the features on TIKR Terminal, I've effectively been able to automate quite a lot of my valuation process, particularly when it comes to bringing in data from other sources. And then that brings me on to my forecast for the business. So we can see here a compounded annual growth rate of 15%. And actually what I've done is I've gone to TIKR Terminal once again, I've looked at the analyst consensus estimates, and that takes me through to 2026. And actually I've effectively just input those into my model for the next 5 years. Now the great thing about that, of course, is that I can consider what I think for the business, and then I can also look to the analyst consensus estimates, which is going to have a load of analysts that are studying this business in depth, and see how that lines up with my own personal expectations. I previously had a compounded annual growth rate of 15%, and analysts are actually predicting for a compounded annual growth rate of 15%. So that gives me even more assurance that my thought process on the business is probably fair. And then for the 6 to 10 year revenue growth, I've gone with 10%. Now the reason for the decline is simply because as the business grows, it makes it even more difficult to grow even further than that. With that being said, look, we're going from a revenue of $470 billion in 2021 right the way up to $1.5 trillion by 2031. So there's still a significant amount of growth in this business. Now, in terms of gross margins for the business, we're starting at 42%, and I'm expecting that to effectively slowly tick up over time until we start to sort of plateau at around 48% gross margins. This isn't a business that you're going to see 70 or 80% gross margins in, simply because of the nature of the business. With that being said, the Amazon Web Services stake of the business will continue to drive that gross margin higher. Similarly, with operating expenses, we can see here that the average over the last 5 years was 35%, but it has ticked up significantly in 2021, as I was referring to earlier. I'm expecting that to slowly decline over time before we effectively hit a plateau once again of around 33%. In my model as well, I've also massively normalized the gains from their Rivian business, simply because I don't expect that to continue going forward. So where we've got non-operating income here in 2021, it was actually $13.2 billion, most of which was the Rivian gain. For 2022, I'm expecting that to sit at $3.2 billion, and I'm actually never expecting that to get anywhere close to the $13 billion gain that they posted earlier on. Now, in terms of the unlevered free cash flow for the business, so we see here that my unlevered free cash flow is actually negative $20.5 billion, which is very different from the negative $9.1 billion that management posted as their non-GAAP free cash flow. And the reason for that is because I don't add back stock-based compensation. So if we do add back stock-based compensation, which was around $12 billion for the year, well, then actually you get something a lot close to the non-GAAP free cash flow. Now, in terms of that unlevered free cash flow as a percentage of EBITDA, we can actually see, with the exception of the most recent year where they absolutely went crazy on their capital expenditure spend, we see an average of around 45%. I'm actually expecting it to peak at around 65%, and I don't think that it'll be able to get it any further than that. So then that brings us to the fair value of the business according to the inputs that we discussed. So from a discounted cash flow perspective, we're looking at around $3,500, and on a multiple of earnings basis, well, we're looking at a similar metric, right, around $3,400, and that's based on a PE ratio of 20 in 10 years time. Now there might be a little bit of pushback on that PE ratio in 10 years time of 20, but considering the moat that Amazon actually has, which is their incredible infrastructure, which they're continuing to invest in today, I think that a PE ratio of 20 is actually more than reasonable. That brings us to an intrinsic fair value when we take the average of both of those of around $3,500, which means that despite the 14% increase that we saw today, we're actually still looking at a margin of safety of around 9% for this business. I then also have a 2026 price target for the business, which is based on an enterprise value to EBITDA multiple of just 22. And we're actually looking at a 2026 price target of around $6,200, which would be a doubling today in 5 years, or a compounded annual growth rate of around 15.5%. Now, in terms of why I think that a multiple of 22 is reasonable for this business in 5 years' time, well, once again, I flick across to TIKR Terminal. You can see here the average is around 36, and therefore I think that a mediation down to 22 is more than fair, considering that the business will have started to slow by that point. Anyway guys, I hope you've enjoyed the video and I hope you've taken some value from it. Now if you are interested in TIKR Terminal and you are somebody that likes to be data driven with their investments, then I'd strongly recommend you going and checking them out, and I'll leave my referral link in the description below. Now just for full disclosure, if you do click on that link and sign up, then I will get a referral fee for that, but genuinely it helps me so much in my investment journey that it's probably worth taking a look at the very least. Anyway guys, until next time, thank you.